Good morning from our global headquarters in New York. I'm Menace Craney alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
The job's not done yet. Fed officials say the fight to tame inflation isn't over, ahead of JOLTS, jobs, and minutes. Mounting pressure from multiple reports that Canada's Prime Minister Trudeau is likely to announce his resignation this week. And all in one, House Speaker Johnson vows an ambitious bill to deliver President-elect Trump's policy priorities. Good morning, Manus.
Danny, good morning. He lives to reign another day. We'll talk politics in just a moment. Stocks a bid this morning. You've got Nvidia up. You've got all of the tech stocks rallying. We've snapped 5 days of consecutive declines that wiped $1 trillion off U.S. equities. Manufacturing's at a 9-month high. The Mag 7 had a nice buy the dip moment on Friday, rallying by 2.5%. Evercore say we're at an inflection point in automation for the golden age. We'll talk more about that in a moment. The bond markets are settling in for $119 billion worth of auctions this week. 3s, 10s and 30s. 30-year paper, by the way, has made it to the highest level since November 2023. And there's a trifecta of Fed speak, Danny, isn't there? From Barkin, Daly and Kugler, all really hesitant to say the job is done. Stay restricted from now from Barkin. So we're also keeping an eye on a couple of other stocks for you. These are some of the names that are in the frame Monday morning. ASML rallying after its US peers gain. This also comes as Microsoft's commitment to invest further on data centers also hands a potential boost to the companies.
We also see shares of Boeing. Those are rising in the pre-market 1.8%. Barclays has upgraded it to overweight from equal weight. They've turned positive on the stock for the first time since 2019.
That almost deserves a clarion call. Paycheck is in advanced talks to acquire Paycor. It's the smaller rival in the payroll processing. A deal may be announced as soon as this week. That's according to people familiar with the matter. And in just a few moments, we line up the week ahead with Sonja Marten of DZ Bank and later in the hour, Stephanie Guild of Robinhood on the markets. Danny, good morning.
Good morning, man. It's the first kind of full week of the year. Of course, we do have a Thursday pause in equity trading to remember President Carter. But besides that, we're basically back in action.
Back together, back in action, and I think it's going to be, I actually think it's going to be much more about FX. The question is this: I was watching Stephen Major over the weekend, and also you look at Ned Davis, and they're both talking about exceptionalism. Exceptionalism may be being fully priced in. The rates market by Stephen Major, but of course, policy in the first wave of the second Trump administration is going to define the trajectory for a lot of these markets.
We've built this consensus that the year ahead is going to be euro-dollar parity.
Yep.
It's going to be higher equity, something like 7,000, and higher rates. Can those three things all exist at once? Are we going to have a moment where FX volatility or higher rate volatility means that risk can't continue on as it has been?
Well, there's got to be some kind of an inflection point. We've had people come in that don't want to be that brave and say rates are going to be 4% to 5%. There's a coalescing of the willing at around 4.6, 4.7%. Equities, can they really get to 6,800, 6,700 if you break towards 5? What is it that breaks you towards 5% in bond yields? That's the big question for us.
Mike Wilson says no of Morgan Stanley, out with a note this morning saying that the most important variable to watch in early 2025 is the correlation of bonds and equities, that now that rates are back above 4.5%, that negative correlation has returned.
Well, we've got a lot of different questions to put to various people. I think the one thing just on that, Danny, when it comes to how healthy is the consumer, Torsten Slok has 10 charts. You've got to read through his note. It's about credit card as a share of disposable income, and it's also the effective mortgage rate. You got it. We're paying around 4% in this country when really mortgage rates are up at around 7%. So it's about the strength of the consumer 2025.
Well, when it comes to the Fed, Manus, this is also going to be a big variable. How many cuts will we get? We got Fed speak on Friday. Let's just go through what they said. We heard from Barkin saying that they will stay restrictive for longer. Mary Daly saying inflation is still uncomfortably above our target. Adriana Kugler saying the job is not done, reiterating what we had seen from the Fed in their December decision. Joining us now is Sonja Marten, head of FX and monetary policy at DZ Bank. Sonja, what do you make of the Fed speak? It doesn't sound like this is a Fed who's going to be jumping into cuts in 2025.
Well, yes. I mean, it's a difficult start into the year for the Fed and for all of us because we have a big unknown in the equation. In 2 weeks' time, Donald Trump will take office. And to be honest, none of us really know what's going to happen afterwards. I mean, he's been talking the talk, it's been very threatening behavior in terms of, the threat of tariffs. And that's going to be obviously crucial for the Fed. But ultimately, none of us, possibly even not himself, know exactly what will happen once he takes office. And as far as the Fed's concerned, the big unknown and the big risk factor are the tariffs. If Trump does impose high tariffs early on in his presidency, that is going to impact inflation, and that's going to close the window for rate cuts. And that's the problem that the Fed has right now. So they're flying blind, as most of us are, and we'll kind of have to wait and see what happens when he takes office. And maybe we'll get an idea in the weeks after that what he plans to do first.
Sonja, good morning to you. 2017 saw the dollar drop by nearly 10%. I'm rounding a little bit aggressively there, 9.8%. The world was very different. The capital flows are very, very different in 2025 to 2017. Is there some kind of a toleration, or what is it that Trump wants to achieve in terms of the dollar? Does he come in day one, jawbony, this is too high? Because 2017 gave you a 10% drop. I can't see that landscape for a 10% drop this year. Can you?
No, absolutely not. I mean, 2017 was very different because when you look at 2017, we had, Trump's presidency was very erratic. People were just getting used to the whole new Trump era. The optimism of the early days had sort of dissipated. But crucially, I think, when you look at euro dollar in particular, then we had a fairly strong euro, which was able to compete against the dollar and actually outperform it. That's not going to be the case this year. I mean, we're looking at a weak euro. So even if the dollar does begin to struggle later on the year, which it may well do, given that, the growth burst once Trump takes office is going to be short-lived. There's going to be concerns about debt levels, etc. But none of that will matter too much to the dollar if everyone else is looking weak or even weaker. So this might be a race to the bottom.
And many other economies would welcome weaker currencies if they are going to face tariffs and want to get out of weaker growth. Sonja, we've just seen this spat already of intervention even before Trump has come into the office. You have the Philippines last month vowing to stepping in to support their FX market. Indonesia vowing the same. Brazil spending billions guarding the real. The PBOC trying to find that anchor for the yuan. To what degree is central bank policy in 2025 about being defensive? What is the balance to strike about letting the currency weaken but not letting it do so unduly?
Well, this is going to be a very fine and very difficult balancing act. If you look at Europe, for example, I mean, euro dollar is now, it's not a parity, but let's face it, it's fairly close to parity. And we're starting to have a discussion here as well about the damage that a weak euro can do. I mean, even when you look at Germany's export-oriented economy, you'd think that a weak currency is a good thing, but of course it has downsides. It brings imported inflation, and a too weak currency does more damage than it does any good. So obviously a number of countries are in that position. Defending your currency, however, against a fundamentally established trend is really, really difficult, if not impossible. So, there's a limit to what central banks can do. And if you're going to enter that arena and fight that fight, you better make very sure that you have a chance of winning it. Because if you intervene and the currency keeps weakening, really you're going to have a massive loss of credibility. So it's a really risky game to play for those central banks.
Well, we saw a little bit of that this morning, a way to sort of trying to jawbone the yen, but it really having the opposite impact. In other words, yen dropping. So the credibility of jawboning is dissipating. Let's delve into the euro a little bit more deeply. We've had various people say to Danny and I, if we do make it to parity and below parity, it would be a short-lived shock. It'll be deeply undervalued at that juncture. Would you concur with that? Or do the politics, the disaggregation of politics in Germany, in Austria, and in France mean that we stay sub-parity for longer than normal?
I kind of tend to agree with the assessment that, while we are bound to go to parity, and if we do, then obviously we will go below, I am also not convinced that we'll, see massive sub-parity levels for prolonged periods of time, mainly because I just feel that, at this point in time, a lot of the negative news for Europe are priced in. A lot of the positive optimism with regard to the U.S. economy in the first Trump, months is priced in. So to me, it just seems there's going to be a limit to how much further we can go. I mean, how much are these factors going to still be able to drive euro dollar lower? Because at some point, the surprise momentum is gone and it's just, business as usual. So while I imagine euro dollar is going to stay at low levels, I'm also not a big fan of these sort of massive sub-parity expectations that some people are currently talking about.
You also have the factor of weather, Sonja, and it's come back into the fore because you have no longer natural gas coming from Russia into the rest of Europe. You have a cold spell. I know it's not quite cold there yet in Frankfurt, but I think by the end of the week, you're going to get below freezing like we have here in New York. It's a U.S. and European phenomenon with really this cold snap expected. To what degree could we have an energy-led inflation reemerge in much of the developed market?
Well, obviously, it is a major risk factor. And as you said, it is very much a weather-dependent phenomenon. And, we have a different energy supply situation than we had, before the war in Ukraine. So that is a risk factor. And of course, when you look at Europe, to make it worse, as I said before, we have a weak euro. And that means that energy costs for us are even higher because you have the combination of higher energy costs per se, in addition to the currency effect. Energy usually is paid in dollars, not in euros. So we have that double whammy. And I think that is definitely something the ECB is going to have to keep an eye on, because obviously they're on the path to cut rates quite aggressively still from here and to move into slightly expansionary territory. But obviously, if we do get, an effect from the inflation side, and may that be due to temporary factors, then that will have to be taken into consideration. It could force the ECB to take a pause at some point in the cycle.
Yeah, well, as we're talking about potential for parity, I'm just looking at the euro dollar up 0.6% this morning. So it's doing everything in the different direction to the conversation that we're having. Sonja, thank you so much for setting the tone this morning, this Monday morning. Sonja Marten there at DZ Bank. There are other stories trending on your Bloomberg terminal. Let's get you through them. China has reaffirmed its support for the yuan after its slide last week. Fan speculation that policymakers would allow it to depreciate faster. Despite the PBOC's efforts, investors remain bearish on the yuan, with many predicting it will weaken in the coming months due to a sluggish economy and the potential increase in U.S. tariffs.
Meanwhile, as you mentioned, Manus, BOJ Governor Ueda reiterating that he will raise the benchmark rate. The economy continues to improve this year. BOJ watchers have been looking for clues on whether the central bank will raise rates either this month or in March. That uncertainty and a continuing strength from the U.S. dollar has kept the yen relatively weak.
Shares in Asia liquor and beer makers, they're declining. The U.S. Surgeon General outlined a direct link between alcohol consumption and heightened cancer risk, calling for warning labels. However, if there are regulatory changes, it may take years to come into effect.
That was on the news literally everywhere this weekend, right after your post-holiday season. Okay, coming up, Canadian Prime Minister Justin Trudeau expected to resign. We're going to have more on that report from the Globe and Mail coming up on your Bloomberg Brief.
It is Bloomberg Brief. I'm Manus Cranny alongside Danny Berger here in New York. Canada's Globe and the Mail are reporting that Prime Minister Justin Trudeau is expected to announce his resignation as the Liberal Party leader this week, triggering a contest to replace him. Let's bring in Stephanie Baker for more. Stephanie, so this is brewing. Trudeau has been in purdah almost from the press since before Christmas. He is running out of support like snow off a ditch at the end of winter, isn't he?
He's been under pressure for months, but the pressure really began to build after his finance minister, Chrystia Freeland, resigned 3 weeks ago, saying they had differences over policy, both how to respond to the cost of living crisis, as well as how to respond to Trump's threat of tariffs on Canada. And I think that only caused more Liberal MPs to turn against him and call him to resign. His popularity rating has sunk precipitously since he was first elected. But the real question, I think, is how does he respond to these Trump tariffs? And I think people are questioning whether or not he's the right person to take on Trump, given the threats that the incoming U.S. leader has made against Canada.
We see the loony rallying today, Stephanie, on this idea that maybe you do get someone who can better take on Trump. Meanwhile, you have across the world, a lot of this is happening. In Austria, coalition talks falling apart, the coalition government likely leading the way to someone from the far right coming into the government. Canada, Austria, elsewhere, are these governments that are essentially shifting in positions that are either more Trump-friendly or ones that can better take on Donald Trump?
Right. It's part of a trend of incumbents losing power and leaving office. And I think Trudeau is another casualty of that. It's also another sign of how Trump is having an outsized effect around the world without even entering the White House. And I think, the thing to watch in Canada is who potentially takes over for Trudeau as the leader of the Liberal Party. Is it, as many suspect, Mark Carney, the former Bank of Canada and Bank of England governor, who has been apparently making calls to various Liberal MPs, trying to figure out if he can launch a campaign. He is not as charismatic of a political leader, but he does have the kind of economic credentials that you might want to take on and respond to Trump's threat of tariffs against Canada.
Stephanie, thank you so much. That is Bloomberg's Stephanie Baker. And we would just remind viewers as well that Mark Carney is the chair of Bloomberg Inc.'s board of directors. Now, meanwhile, more geopolitics, more relations to Donald Trump. Italian Prime Minister Giorgia Meloni flew to Florida to Mar-a-Lago to meet with the president-elect over the weekend. And it comes ahead of President Biden's last overseas mission as a president to Rome, where Meloni is expected to host him. Let's bring in Bloomberg's managing editor for Southern Europe, Tommaso Ebhart. Tommaso, Meloni going to Mar-a-Lago, already talking with Elon Musk, saying that they're going to host some sort of interview on X. Is this the relationship that the White House will have? Is it Meloni serving as kind of the ambassador to the wider Europe and the interaction that we're likely to see between the two nations?
It's quite interesting to see, the Italian Prime Minister going on a surprise dinner with Trump in the U.S. over the weekend. She went to meet Trump, and then she came back to Rome in about, less than 20 hours. This caught by surprise, I would say, everyone in Italy, including some members of her government, according to Italian media. What is clear is that Giorgia Meloni is cementing his role as one of the more stable European leaders. This is something that Italy is not used to, and actually is becoming now something solid. Meloni's government is one of the more stable in Europe, and is looking that she could become a cornerstone of the European relation with the new U.S. administration. The trip over the weekend clearly made the case.
Well, it's very clear that the world is trying to understand who to connect with in Europe. Macron and Olaf Scholz are somewhat debilitated. I mean, this is the Mutual Admiration Society between Meloni and Musk. Corriere della Sera, Meloni calling Musk a genius. On Meloni, Musk calls her authentic, honest, truthful. Tell me this, how do people in Italy look at this relationship? How do they look at this deal that's being done with Starlink on the government's securitized communication? What's the feeling there in terms of this transatlantic mutual admiration society?
So we have to say that today, the news that Italy is in talks with Starlink for a satellite connection contract in Italy is on the front page of every Italian media, and is being looking differently from, the party, the Meloni's party, and the opposition leaders. The opposition leader are asking Meloni to come to parliament and say if there is any special relation with Elon Musk, which could have consequences on contract for the public administration. What we reported, our scoop from last night, is that the Italian government has been in talks for months now to get a system to have a secure connection for its defense industry, and Starlink seems to be the cheaper and the most secure one. We wrote last night that any other deal for the Italian military service would cost around 10 billion euros, while the Elon Musk one could cost 1.5 billion. So it could be much cheaper for the Italian administration. Then clearly the fact that the news comes out soon after Meloni come back from the U.S. could not be just a coincidence.
Well, certainly Italy's going to have to do a little bit more when it comes to defense spending. They're still a little bit short on that U.S. ambition for everybody in terms of their contribution. Tommaso, thank you very much. Our Southern Europe managing editor, Tommaso Ebhart, there on the very latest trip of Giorgia Meloni to Mar-a-Lago on Bloomberg. Monday morning, time for your front pages from around the world. This is what's making headlines for you. First up, Washington Post leads with a winter storm. It's going to affect several states across the country. The worst of the weather will be over the mid-Atlantic. Now, the mayor of Washington, D.C. has declared a weather emergency through to at least Tuesday.
Yeah, Nat gas prices up some 8% this morning. Next up, the New York Times. If you stayed up late last night, apologies to you, but it probably meant that you got the Golden Globes. Emilia Perez and The Brutalist winning the top film prizes for comedy and drama at the Golden Globes. In the TV category, Hacks won Best Comedy Series. And Manis, again, it was Shogun that basically won everything.
Yeah, I mean, it really did sweep the boards. We'll see what the Oscars have on March the 2nd, who's in there. Tilda Swinton did well last night as well, saw that movie. Let's talk about what's on the front of Bloomberg. New York City kicking off its congestion pricing after years of delays and political wrangling. The new toll began just after midnight on Sunday, with today being the big test for commuters. Now, it is just gone 5:25 a.m. This hoping to raise $15 billion for the MTA. That is Lexington and 3rd Avenue. Thankfully, 5 cars have come into the shot since we came back from commercial break. But this is about this is about raising money, $15 billion, Danny, and about reducing congestion. Will they go the way of London? That's the question I have.
Hey, I'm all for the subway getting better, but we already pay so much in city taxes in New York, and the subway hasn't gotten better. And by the way, if you're commuting into the city from New Jersey or anywhere else, you're already paying a really hefty toll charge for the bridges and tunnels. I mean, you can pay more than $20 trying to get into the city.
And the bridges and tunnels fees are actually going up as well. Now, I'll leave it to an American to criticize whether the subway system is actually not that good. In London, it was launched in 2003. It was $8. It's now $18. Although congestion is down and bicycling is up by 137%.
That's inflation for you. The Fed's maybe got a hike. I don't know. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manis Cranny. Let's set your agenda.
The job's not done yet. Fed officials say the fight to tame inflation isn't over. Ahead of jolts, jobs and minutes. Mounting pressure from multiple reports that Canada's Prime Minister Trudeau is likely to announce his resignation this week. And all in one, House Speaker Johnson vows an ambitious bill to deliver President-elect Trump's policy priorities. Danny, good morning. These markets are really trying to find their feet this morning.
Yeah, it's maybe the unofficial start of the year with so many people off last week. With the Mag 7 leading the declines in the days prior, 5 days of losing. That was snapped on Friday. It is yet again tech that reverses things, leads us higher. NASDAQ 100 futures up 0.7%. Bond yields, those have been moving higher. You had strong data coming in on Friday. The move continues today. Your 10-year yield decisively above 4.5 or at 4.6%. 30-year yields at 4.83%. That is now the highest level since November of 2023. Lots of Fed speak, Barkin, Daly, Kugler, all saying relatively the same thing, that inflation's uncomfortably high, Manis, and we know the job is not done.
Yeah, they want to stay restricted for longer. That's according to Barkin. Those bond markets are up. 10-year yields are at the highest since April the 30th. Last year, and 30-year paper, that's where the real worry is, because that says to you people are worried about tariffs, they are worried about a de-anchoring of inflation or a resurgence, let's say, of inflation, or not making the last mile down to 2.
Yeah, and lots of supply. Look, the bond auctions that we've had more recently have gone off without a hitch. You mentioned we're going to have more this week. At what point does it finally turn? Do we get more nervous about the supply coming in with all of the spending and the lack of fiscal restraint that we expect from Washington, D.C.?
Yeah, you're going to get 3s, 10s, and 30s. You're going to get $119 billion worth of paper. And then you have a tilt in the Fed as well. You've got this pivot, this slight pivot in the Fed composition in terms of doves to hawks. You're going to move from 4 over to 5, and the neutrals move from 3 to 5. So there is a tilt in there as well.
Well, that's why I'm so interested for minutes, because remember, last Fed decision, we did have a dissent. And you have had more Fed speakers putting the emphasis not on the labor market that we saw in 2024, but instead 2025 is one so far where the focus is on inflation.
Well, let's have a look at the S&P 500. December was a bit rocky. We gave back 1.7%. It was a pullback. It was the 5th worst December, actually, in 35 years. We seem to have found our feet at the start of this trading week. We've broken trend on those 5 consecutive declines. Our guest this morning is Stephanie Guild, Head of Investment Strategy over at Robinhood. Stephanie, good morning. Happy New Year.
Happy New Year.
We have this collective bullish consensus. Take your choice. 6,500 up to 7,100. Who did we say 7,100 was? Oppenheimer at 7,100. Yeah. That is a pretty incredible consensus of bullishness. Can that live, as Danny said, can that coexist with bond yields at 4.6, 4.75%. That's a tough one to square, isn't it?
It's tough for valuations, for sure. There's three things I think that matter all the time, no matter what's happening. And that is sentiment, to be sure, valuation, and earnings growth. And I think a lot of it will depend on earnings growth then. Like, can you have the earnings growth that outperforms a stubborn interest rate environment? And that's why, but I do worry about the sentiment. Like last year, this time, you had actually a wide range of estimates that even some were negative for the year, and they all had to play catch up. And this year, they're all starting out bullish. And that's why my target is on the lowest end of that range. It's at 6,500 for the year. I just want to see where things go, too. I think this is that environment where you have a transition in the administration and you just have to see what their policies are going to be.
Well, there's this hope for strong growth and that margins can keep expanding because you get deregulation, because you get tax cuts. But if those things also lead to higher rates for longer, which becomes the more important driver for equity markets?
In the short term, it will be interest rates. In the longer term, it will be growth. And if you can get it, great. And I actually think there's a good possibility for it, which is why I still have a positive view. And it's why I'm more bullish, perhaps, on mid caps because of better valuations there. But it's something for sure to watch. I think we've seen the worst of the 10-year move for now. But there's certainly risk for higher. In my outlook, I put 5%.
It was interesting that we see Speaker Johnson retain the gavel. We'll talk more about that politically later. But it now looks as if they're going to go potentially for one massive bill, energy, defense, and tax. Now, that comes with a huge political reward if they manage to get it through. But it also has huge risks to this market. How dependent are we on that one-stop shop bill with tax cuts coming through, sort of unabated?
I mean, I don't know how they're going to get huge tax cuts done, especially in the corporate side. Like the last time, it was 35% or something, 34%?
Down to 21.
Down to 21. How do you make it much lower? We're right in the middle of the pack globally. You could improve it a bit, but where are you going to get the funds from? We have a deficit of close to $2 trillion. Of the money we spend, 4 of the $6 trillion that we spend come from Social Security, Medicare, and Medicaid. They've come out and said they're not going to touch that. How? Then we're playing with tiny little peanuts, in my opinion.
Yeah, and then it's the weird thing of you get tax cuts, but there are exceptions depending on where you build your products.
And it's always over 10 years and not fixing anything in the media. And you do have the bond vigilantes are back out again, like they were in the 80s, right? And interest as a percentage of GDP is, interest payments, I should say, as a percentage of GDP are back to the levels when the bond vigilantes were out.
Do you think the bond vigilantes can actually have an impact this time? Is this a Congress? Is this a President Trump will be swayed by machinations in the bond market?
Margins are thin in terms of, decision makers. And if you thought about the last time, this bill they tried to push through to move the debt ceiling, they tried to actually put the debt ceiling, on hold basically for 2 years, and they couldn't get it done because of the bond vigilante. So I think it's possible that there is a faction that tries to defend our budget.
Well, it's going to be because Steve Rasciuto joined us and he chided me. He said the bond vigilantes, they don't exist anymore. It's not the 1980s, man. It's not the 1990s, the last time that you were butchered by the bond vigilantes.
I think it matters again. I really
See, this
do.
is interesting. So you think the bond market will be the tail that wags the dog here?
From a macro perspective. But from a micro perspective, I still think there's a lot of opportunity, and I don't want anyone to forget that.
I know, and I get that. Can I just square away then?
Yeah.
So can the Mag 7 coexist in this slightly higher regime of rates? Because we are pretty much there. Their earnings are going to grow by, 18%, down from 34%, but that still puts them in pole position.
Yeah, I mean, if you look at the top 10, like their earnings expectations for 2026 are only 6%. So I actually think they're not overvalued when I look at it from that perspective. And they do have a lot of, they dominate everything. Yeah. So they absolutely can continue. But I also know if you look like even in 2024, there were 140 names that did met or beat the S&P 500. Like there's more to life than the Mag 7. And you saw them in the top 10 returns this year, right? Like United Airlines.
There's more to life than Mag 7.
I'll sell it.
United Airlines was in the top 10 returns. Like, who would have guessed that?
It's such a strange place to be in, Stephanie. And I hear it in what you're saying, and I hear it in other people that you can still be really positive and even bullish, but still have some negativity in the back of your mind.
Yes, you have to be so careful this year.
But the other narrative that has been part of this year that everyone seems to be consensus on is one of U.S. exceptionalism.
Yeah.
But if the rest of the world is facing political instability, is potentially facing currency volatility, at some point, does that come back around to U.S. assets? Is it a zero-sum game that the U.S. is going to do well as long as everything else does bad?
It depends, right? Because if you have higher interest rate here, then that means we're kind of exporting inflation. Like you have all these things that just like continue to help us and hurt other countries. But I actually think Japan, for example, is a place that I'm still positive on, despite the fact that it's had some rough goings from the currency.
Is this the equity market you're positive on in
Yes,
Japan? And why is that?
Market. I just think that they were left for a long time for good reason, right? And everyone, we said during the break, everyone always plans for the last disaster. And I still think there's a lot of good coming from there. Yes, they have demographics against them, but I really think a lot of the secular policies they put in place, even during Abe, will continue to help them.
You also have Warren Buffett on your side, which is not a bad place to be. Hey, Stephanie, thank you so much for joining in the new year. Happy New Year to you. Stephanie Guild of Robinhood. Okay, let's get to some of the other top stories that are trending on your terminal this morning. China has reaffirmed its support for the yuan after it slid last week. That has fanned speculation that policymakers would allow it to depreciate faster. Now, despite the PBOC's efforts, investors are bearish on the yuan. Many predict it will weaken further in the coming months with a sluggish economy and potential American tariffs.
And the BOJ governor, as we were just saying there, Ueda, reiterating that he will raise the benchmark rate if the economy continues to improve this year. This comes as the BOJ watches see clues as to whether the central bank will raise rates this month or March. Now, the uncertainty has kept the yen at a relatively weak level, and it's actually declining on the back of those comments from Ueda this morning.
Meanwhile, Steve Diggle, a former hedge fund manager who made billions back in 2008, he is ready to pounce on volatility again and bet on market swings. He sees threats to market stability. He cited factors like the stretched U.S. stock valuations, prime office glut, and geopolitical tensions, all in an interview with Bloomberg. Highly recommend you give that a read. Coming up on the show, after nearly 12 years, Canadian Prime Minister Justin Trudeau is expected to resign. We're going to have more on that report for you next. This is Bloomberg. It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. Canadian Prime Minister Justin Trudeau is expected to announce his resignation as Liberal Party leader this week. That's according to multiple reports. Let's bring in Bloomberg's Stephanie Baker for more. Stephanie, how likely is it that Trudeau is out?
Well, that's what the reports are saying. I mean, he has been under pressure for months by his party to step down, but that pressure only intensified 3 weeks ago when his finance minister, Chrystia Freeland, surprised everyone and quit, saying that they had policy differences, in particular over how to respond to the cost of living crisis, as well as the threat of tariffs against Canada from Donald Trump. If he does resign, this really would be an end of an era. It would be another sign of this anti-incumbent wave that we've seen over the past year. Trudeau has been prime minister for almost a decade, and I think the question is who will replace him as leader of the Liberal Party. There has been talk of the former Bank of Canada and Bank of England Governor Mark Carney taking over, and some believing that he has the economic credentials to respond to the threat of Trump tariffs more effectively.
Well, in terms of the leadership, it would look and sound as if Trudeau does not have the support. I mean, multiple caucuses, Ontario, Quebec, and Atlantic. The question is Canada ready to have somebody like Mark Carney, who's a non-politico at the moment, step into that fray?
Yeah, and this is the real question. Is this the time for a sort of technocratic leader like Mark Carney, who has the sort of business savvy that might be needed at this time, given the threat of tariffs from Trump? Canada is at a crossroads. It's facing an election later this year. The Conservatives are expected to win that election, and can whoever they accept to lead the Liberal Party, can they mount a challenge to keep in power? That remains to be seen.
Yeah, and we should note to our viewers that Mark Carney is the chair of Bloomberg Inc. Stephanie, and just to clarify, and maybe even correct what I said earlier, that Justin Trudeau has been head of his party for more than 12 years. He's been prime minister for about 9 years. It is a big change to have him step down, and in reaction somewhat to Trump, who hasn't even come into office yet. This is something we're seeing around the world. What moment is this for global leadership? Is there a political vacuum right now as the decks are reshuffled?
Right. I think, you're right. Trump is having this outsized effect around the world without even entering the White House. But the economic threat, for Canada is huge if Trump goes ahead and imposes a 25% tariff on all goods from Canada. Now, Chrystia Freeland, before she stepped down, she had said she wanted to keep the fiscal powder dry to respond to the Trump tariffs. And I think there was a division over how to do that with Trudeau. And I think that will be an enduring debate within Canada as to how most effectively to respond to the threat of Trump tariffs and how they can head those off.
Okay, Stephanie, thank you very much. You're right, it is going to be a year where perhaps a few more incumbent heads will roll. Stephanie Baker there for Bloomberg. Mark Carney is, as Danny just said, the Bloomberg board, the chair of Bloomberg's board of directors. Let's shift focus to Washington. The House Speaker there, Mike Johnson, fresh from his re-election as he turned to Trump's agenda. Johnson told Fox News that Congress would get one big bill to vote on by April, which addressed President-elect's priorities. Let's take a listen.
Beginning immediately, we, as you said, indicated there, we gathered all the House Republicans together yesterday and had a full day of work. We went to Fort McNair, which is a short drive in Maryland, and everyone was enclosed together for 8 or 9 hours straight, talking about our reconciliation agenda and the America First agenda. We're 15 days out from the inauguration of President Donald J. Trump for his second term, and we want to make sure that we're jump-starting the agenda now over the next 2 weeks so that he's prepared and ready on day one.
Well, let's catch up with Meghan Crane. She's in Washington for us. Meghan, look, this is Johnson retaining control. This is the Republicans finally uniting. The question is, how long does that endure? One big bill. The reason for pivoting to one big bill rather than splitting this in two across the year, is it because they're concerned about political capital running out over the period of the first 8 months of this new administration?
Good morning. I'm not sure it's about political capital more than just the ability of Mike Johnson to herd cats and get enough of his members to support a single bill. Obviously, any legislation requires compromise, and there are members of the House Republican caucus that are not particularly interested in that. And that, was evidenced by the fact that it was difficult for Johnson to even be reelected Speaker, which is essentially a pro forma thing, or normally has been. So I think there's a lot of calculation going on there. Primarily, they're really the effort to get something through the House.
Meghan, just to that point, by passing things or attempting to pass it up in one, does that mean that policy takes longer to pass or it comes quicker? I know Lindsey Graham was upset about this idea that you wouldn't get some of the things like energy and border up front, that you have to wait for it all to be in one go. What does that mean for the timeline, for the order that things are passed in this Congress?
Right. So that's a really interesting sort of part of the calculation. I think they're maybe concerned that Donald Trump will become impatient with this timeline. If you're talking about things, one big bill is going to take months regardless. Speaker Johnson spoke about April, and that's a long time if you're trying to sort of come in with a lot of momentum like Trump will be. I think, it just goes to the fact that there are things that will be easy to pass, but they want to tie them into things that are not so easy to pass. And that's just how the legislative process works. The Senate wanted at least 2 bills, and Johnson clearly doesn't think he can get those through.
No, it looks as if they're going to go through a reconciliation, which is a simple majority in the Senate, rather than have to rely on those Democrats. Look, today's incredibly important and significant for a number of reasons, but Congress counts and certifies the results of the Electoral College votes. So what should we look out for today in terms of politics in the House?
Well, today is one of those Washington things that is very important, but most people didn't notice until 4 years ago. The certification of the election results. Kamala Harris will oversee that process and has certainly made clear that she will certify those election results. The politics of it are sort of unpleasant all around. The Republicans don't want to talk about what happened 4 years ago on January 6th, and the Democrats are more than happy to highlight that. But things will proceed today as they have for hundreds of years, and we'll just sort of move forward. The real question then will come in 2 weeks, see what the president-elect does about pardoning people who participated in the insurrection on January 6th into 2020.
Megyn, thank you very much. Megyn Crane in Washington. It's going to be a big week, both in terms of economics and politics, as Megyn was just saying there now. Some of the big economic data and the Fed minutes will be across this slate throughout the week.
And we want to bring you some live pictures of the late former president, U.S. President Jimmy Carter, laying in state in Atlanta, Georgia. He's at the center, the Carter Presidential Center. He will remain there until Tuesday, January 7th at 6 a.m. local time as we observe the funeral of the Nobel Peace Prize winning former president Jimmy Carter. It's your Bloomberg Brief. Danny Berger, Manus Cranny in New York. Let's get you set up for your trading week this week. The latest Fed minutes, those will be coming out on Wednesday with one dissent in the last decision. Then equity markets, they will be closed in the U.S. on Thursday for National Day of Mourning for the late former president, Jimmy Carter. Bond markets will also be closing early that day. Then the December jobs report, that comes out on Friday. Manus, that is delayed by a week because you had the holiday shortened week last week.
Indeed, 160,000 is the number that we're looking at there. Some stocks that you want to keep an eye on, Danny, as we go into the trading session. You've got ASML rallying after the U.S. peers really gain. A lot of the tech stocks are rallying this morning. Mag 7 was up over 2.6% on Friday. Boeing is up over 2%. We've got a bit of an upgrade for them. Let's have a look at, keep an eye on that. You've got Paycheck also there as well. The upgrade from Barclays, by the way, to overweight. And Paycheck, let's just round it off with that. Advanced talks to acquire Paycor, which is a smaller rival in the payroll processing business, Danny. So those are three names just to keep abreast of.
Let's also get a check on this bond market, Manus, because it is also on the move. Yields are going higher, above 4.6% for your 10-year. For your 30-year yield, that is the highest level since November of 2023. You had a lot of strong data on Friday, whether it be PMIs, whether you get better jobless claims, all of that, meaning that this is a strong economy. This is not a labor market that's set to crack, and it is a Fed that has been concentrating on inflation over the labor market.
Yeah, and just on that data on Friday, manufacturing at a 9-month high, orders at an 11-month high, and you potentially have this tariff narrative coming from the next administration. We've got $119 billion worth of bond auctions coming in 3s, 10s, and 30s, and it's very much at that longer end of the curve that we've seen perhaps a little bit more of a dislocation in yield. But Barkin says stay restricted for longer. The three of them, Barkin, Daly, and Kugler, all with that hint of, let's say, hawkishness.
Yeah, Daly's saying that inflation is uncomfortably above our target. Yeah. Kugler talking that we know the job is not yet done. This is a Fed that does reflect what we got in December, a hawkish pivot from the Fed. Already, this is a bond market that's pricing in 2 cuts. Do we price out more? Is there more pain to come? Because we don't even know what policy is going to look like yet. There's so many unknowns.
And that takes us back to Stephanie Guild from Robinhood. She said the bond vigilantes are in the wings. They are alive. They can reassert themselves. And that's your problem for stocks. Surveillance is up next.